Dzień dobry Państwu. This panel will be held in English, so I'll start in English, and I would like to invite my panelists, starting with Bogumił Kloc, Head of Sales, Securities Services, Deutsche Bank. Then we have Tomas Packa, Senior Xtrackers Sales from DWS. Adrian Pusz, Packa Asset Management, Senior Sales. And finally, Radek Sosna, Goldman Sachs TFI. This panel is not about regulation, deregulation, simplification. It's not about distribution models. It's about products mostly, and it's also about clients, how clients perceive new products, new product range, and how the cooperation between clients and product providers looks like. We've been hearing a lot over last years about passive investments, active investments, about this so-called passive revolution. We, of course, are all aware of the current tendencies, what percentage of total assets of clients are passive solutions currently, and we are aware that the percentage of assets in passive solutions is growing, but I think we are in a specific moment, and maybe it's a good time to think again about the active solutions. Like, is it a good time for kind of a renaissance of active asset solutions? Or maybe at least a kind of upward correction in this tendency that we see. I'd like Radek to answer this question.
Thank you, and good afternoon to everybody. So it's a very complex question, so also the answer can be multifaceted. I would say that the tide of passive investing is not turning back, but definitely the moment in macro cycle, but also the geopolitics is leaning towards the thesis that the active can have sort of a renaissance or a slightly higher allocation in the mix of the portfolios. And there are, I think, at least two facets to this thesis. First, last 10 to 15 years was very one-directional, sector-wise, country-wise direction of travel, where being passive to the bone, really passive tracker indexing, was the winning strategy. So the role of advisors was more about how to navigate the client through any market turmoils, and to stick to simple strategy and to allocation that was in line with the risk.
And now it's changing.
Now it's changing because we see deglobalization. We see higher interest rates, also because of the deglobalization that fits into this trend, and probably a little bit higher, not extremely high as in 2022, but higher and more resilient inflation due to the undercurrent trends. What does it mean? It does mean that it presents more opportunities for being active allocator between different markets, asset categories, and also that buying only a simple ETF solution might not be the best solution for long term. And it's an opportunity for both asset managers, so the, let's say, building block providers, but it's also a very good opportunity for our dear partners and distributors to present as an advisor more active role, stance towards building this diversified portfolio into the new brave world.
And also for the asset classes or geographies that you allocate into, like out of the United States and into other countries, right?
Which are, by the way, more often less efficient markets. which presents a little bit more opportunity for active managers than the US market, which is the most.
Yeah, obviously. Adrian, what would be your take on this? Are your clients ready for this kind of going more active and looking for this kind of some extra alpha that can be done?
So thank you, witam serdecznie. Thank you for glad to be here. I think you presented a perspective that's close to my heart. It's that of a, let's call it professional, rational allocator. That's not the only one, but maybe on this one first, what we saw, especially in the recent months, is that there were few fund manager or professional allocators who felt confident to make a strong bet, for example, on a specific region, on a specific sector. And from that perspective, we saw quite a bit of demand for differentiated sources of alpha. I don't mean necessarily hedge funds. I mean, for example, solutions that use machine learning, where you can generate alpha that is not attributable in professional jargon to any factor. This is one side. And I think also yesterday, and also referring to what you mentioned, yesterday we heard that the forecasts for global economic growth for the coming years are probably lower than they used to be in the preceding years. The lower the growth, then a big assumption, efficient financial markets, the lower the growth, the more the one additional percentage point of performance counts. And the more those allocators will care to look into them. And from this perspective, we see continued demand for either active strategies, for especially satellite allocations, for less, let's say, well-researched markets, or enhanced indexing for core building blocks. But there's also the perspective of retail, and I'll be just quick. We do see that when clients go out of active, because there's, for example, market turbulence, they go back into passive because their mental shortcut is on the retail side that investing is investing in ETFs.
Okay, so to sum it up, the worse it is in the global economy, the better it is for active investments.
In a way, yeah. I mean, it's obviously simplified, but
simplifying,
yes.
yeah, obviously. Okay, Tomas, at Xtrackers, even you are looking for some extra income that you can have for your customers, right? You have your new products, the multi-factor ETFs that we know from the American markets already, but kind of something new in Europe. Can you elaborate more about this product, about this new product line?
Hi, everybody. Maybe if I can, I mean, just to refer to one point, because it's a two-sided sword. When the equity or when the risk is rising in the market, every move can hit you double. I mean, that's what we have seen right now. I mean, just over the last 5 or 10 years, when not having technology or not having defense stocks can hit the performance of the active asset manager quite a lot. And that was also driving kind of the flows towards the market-based, index-based ETF investment vehicles, kind of to reduce these kind of deviations. But sure, I mean, just more activity, the more possibilities there are. But it's really hard kind of to time or to work in this kind of market insecurities we see right now. So it's kind of full of pitfalls and full of kind of challenges from that perspective. I mean, active, in the US, it's a big trend. So active ETFs kind of enhance indexing with buffers, covered call writing. Over the last few years, it was making up to 20 to 30 NNA share into active, kind of what is, the part of what one is coming into ETFs. So that's huge. US is different because we need to define, I mean, Europe and US. US is very much about the retail investor. So 80% of the US investors into ETFs are retail. Europe is different. Europe is about the retail investors make the minority. So it's opposite. It's 80% institutional, 20% retail or private investors. So in Europe, we have a little bit different kind of way of thinking. And why does it work in that way in the US? there's a tax advantage. So we have heard this topic, how to make investment more, just more eligible or more accessible. So in the US, the ETF is more tax efficient than the mutual fund. So what is the reason to go into the mutual fund? We see kind of this movement out of the standard active mutual funds into the ETF, which is actually just a different wrapper for the same strategy, but cheaper, more transparent. Okay, why? Tax transparency.
Yes, and in Europe it's different.
It's different because it's the professional client base. So here, just the professional clients have, I would say, we have 3 different client bases. First one is kind of the stock selector, okay, so stock selection. Second one is fund selector, so it's a fund of fund, but selecting the best fund managers. And the third one is kind of the asset allocator. So asset allocator is pretty simple, yeah. For the client, in the end, it's about the performance. And where is the performance being generated? I think 80 to 90% source is the asset allocation, not the selection. So here, this is kind of this, I would say, discussion between selectors and asset allocators, because asset allocators, it's a natural buyer of ETF. Why? Because he makes his decision on the asset allocation, that's what's the performance coming from. And the selector is kind of the new group who is, just looking at ETFs, where also active ETFs come into play. So kind of an ETF that is, just for example, we launched a new range that has a multi-factor, dynamic multi-factor approach, trying really to outperform the index based on quantitative models. So you have a very controlled tracking error, but the possibility to outperform. So
something that was usually offered as an investment funds in another vehicle, the same strategy, I would say.
Exactly. At DWS, we also have a huge active platform. So we are just taking kind of the existing strategies out of this QI platform we already have and just bring it into the wrapper of an ETF because that can be offered, just more liquid, more transparent way. And that is kind of the new trend in the market right now, really looking at this kind of active, enhanced ETFs in terms of how to outperform the index.
Okay, thank you. As you can see, we have quite a diversified group of people, not in terms of gender, unfortunately, but we have a representative of a traditional asset manager, of a private bank, of ETF provider, also a custodian services provider. And maybe your perspective on all this, as we see, we have a lot of new products coming, pending. We have some other tendencies on the market, like growth of private assets, and you have to serve it. You have to service all those solutions, and I think there are a lot of other challenges, like T+1, for example. So how do you see it with a lot of new products coming to the market, new tasks? Is it something that, how do you manage?
I think we have this luxury that we are agnostic for asset, like the passive, active asset management. We love them all. We, from the custodial perspective, we believe to create the value indirectly in alpha. From the operational perspective, it's U.S. market. It's quite exciting for us. We are direct in states. Last year there was a T+1 switch from the settlements perspective there. It created a bit of problems from the funding misgap, especially on the passive funds. I think maybe there wasn't a big drama as expected, but you can imagine what happened in Europe 2027 when the T+1 happens. There's a nice research done by Firebrand saying that average cost for the small buy-side client is around 200,000 euros to adjust the workflows, operational resiliency, just to make it happen. For the big global custodians, around 30-40 million euro cost. So it's a bit of like the Star Wars in the technology, in a way how you can integrate the workflows, what you can do from the hedging, from the settlement perspective. And I think this is just the start. We talk about different asset classes, so the tokenization, crypto. That would be quite exciting topic ahead. And when I was preparing to this speech, I think there was a nice sentence what I saw is the hype is here. And we see that this tokenization, new asset classes, they happening pretty quickly. And if you are not now investing there, that would be quite difficult to catch up. So from our perspective, very quickly, we investing in the new systems. We hope to be live with digital asset custody next year in Germany and then passport to different countries, hopefully to Poland as well. We're changing our infrastructure for T+1, real-time systems. It's quite exciting as well. You will see what we see when we see how we say. It will be quite exciting. Cloud native, real-time processing, which make the difference for our clients, whether active or passive or different asset class providers. And I think this will be quite exciting. From tokenization perspective, that's a bit of, again, quite exciting topic. We did the first bonds issuance in Germany last year. It was 100 million euro issuance on KfW, fully native, fully digitalized. We're doing the market making on the bonds. It's an amazing story because, like, from the cost perspective, from the issuance perspective, you issue the bonds in seconds. You got the access to the cash in seconds. It creates a super nice story because you got access to liquidity. Issuance cost goes down to probably 5%. Bid-ask spread improved 5%. Better price discovery. Totally new experience. I think the world goes into these directions, and if we as a market we're not looking in this, then it's a waste of opportunity. I think we talk about this investments or savings and investment union, how to make Europe great again in a way. And I think the digitalization, the new asset classes, the automation, operational risk, this is the way forward.
Sounds exciting. Tomas?
Paweł, can I add one thing to this T+1, T+2 discussion? Because it has a really huge impact on the fund management or how we manage the funds or ETFs itself. And there is maybe one implication not everybody is aware of for US equities. I mean, just US equities settle T+1 and all of our UCITS funds in Europe settle in T+2. And we have got this challenge for when trading, for example, on Thursday. So maybe one advice from my side, trading US equities on Thursday is not the best idea right now. Why? Because the brokers on the background, they settle the underlying on T+1 and the fund settles on T+2. That means they need to take risk over the weekend on the book, hence it has to be more expensive. So here trading ETFs with, or also funds with US underlying, you have this mismatch. So all of the other days in the week is much easier for the brokers to hedge themselves and to be more efficient.
Okay.
And maybe just quick one, and this
Please
is quite exciting story to monopolize the panel here, but like if you have a funds, multi-jurisdiction, multi-asset class, multi-market in a way, that comes the fund. So US equities T+1, Europe now T+2, totally mismatch. You're selling the equities in the US, you need to deliver the cash next day. Sometimes you have no access to the subscription cash. So that's a totally mismatch. And again, this is where we as a custodian are quite important, I would say, block in the equation, because we deliver the intraday funding or overnight funding. That's something which differentiates banks in the industry. And again, it's about all technology, people and expertise, where we have 3 points here. I think it makes perfect sense to work together.
Thank you. I would like to go back to the asset classes that you mentioned, some unconventional asset classes, but the question is to Radek, as you work for the International Assets Management Group now, and you certainly have access to different kind of strategies or recommended to clients. How would you describe the current tendencies? Are there any new asset classes emerging in these recommended portfolios? Are there just private debt, private equity, or also kind of tokenized digital assets?
So it really depends on who is your target audience. To be very honest, as a very big financial group and among biggest asset managers in the world, we provide almost every type of products to very various types of client groups. Maybe going and distilling it to the more local context, especially in the retail space, which is the most relevant for the Polish market. We see, especially in private, but especially even more in wealth management segment, that the clients and the advisory is getting more and more professionalized. So the types of discussion you could imagine to have with asset allocators, with fund selectors, with big institutional investors, we see them also coming as more broad market trend to private banks. What does it mean? It again means higher diversification. It's more playing active, passive, core, satellite approach. It's going in equity more thematic, enhanced type of strategy, quant type of strategies using also AI. Then in fixed income, it's diversifying also from the core fixed income to other pockets of less liquid but higher yielding strategies, especially that the pickup is a little bit higher, and it's going into alts. Partially liquid alts for diversification and correlated returns, but more and more is going to private assets. So we see that this standard benchmark reference portfolio of 60-40 for retail, long-term retail client is becoming more 50-30-20. 50 equities, but more diversified, looking also into active and themes. 30% fixed income, but also much more broadly diversify away from core fixed income or investment grades, and 20 being alts. Here, depending on the liquidity or illiquidity preferences, we see either for wealth management clients build up of whole portfolios into various strategies in alts, private equity, private debt, infrastructure, real estate, also secondaries. But for more sophisticated wealth management and private banks, we see a trend of multi-strategies. So instead of building a big program to build a diversified through vintages and asset classes portfolio, you see one multi-asset type of solution, especially that the regulations, especially LTIF2 in Europe, facilitates these types of vehicles also for the retail clients.
Okay, thank you. Maybe 20% recommendation in alternative assets, it's something that is a bit too late maybe for some countries. We know that in the United States the share of this kind of illiquid alternative assets may be even higher in some portfolios. But I'm wondering whether those assets, those funds, are very difficult to value, to like you have, for example, you have a private equity fund and you have to give the market valuation. Is it totally different, I would say, from the daily market valuation of the listed equities?
No, I think it varies from market to market, right? We're in Poland, we know how the valuation works, what are the requirements and complexities here. In different markets, it works a bit of a different way. And fund administrators and custodians of depository banks, they have a different liability set. So that's another one market in a way. Each and every market has a different nuances, different requirements, different risks. But of course, if it's not liquid, it's quite complex to evaluate. And depending on the frequency, it can give you different results, right? So it's quite a tough question with a simple answer.
Yeah, and a lot of dangers ahead, I would say. Coming back to those, let's say, new active, let's say, multi-factor ETFs or any other kind of active ETFs, you already mentioned, Tomas, some groups of investors that are interested in those kinds of products. If you could just highlight who would be the first adopters, which group of investors in which countries maybe, that would be kind of helpful because we would like to know whom to follow.
It's a very tough question because I'm responsible for 9 countries and each country has pretty different setup, different structures, different people just working with the investment products itself. But when to generalize this kind of topic, it's not only about institutional investor anymore. Just right now, sure, the institutional investors, like the fund selectors, those are the first buyers who look at these kind of strategies because they are trying to have a kind of a combination of active strategies in the portfolio. But in the end, just the biggest dynamic we see right now in ETFs also is coming from the retail space. So like in Germany, like in the UK, really direct investments, self-directed investors on the new platforms is a very strong dynamic. And that's also the direction where we see just increased interest also in this kind of more non-pure beta strategies, so to have this kind of enhancement and to see how can I generate whatever additional value there is in the market. But this is something, maybe we are talking about something new. It's not new. We are doing it on our platform for 15 years. So we have kind of these enhanced strategies available for a long, long time, like Yield Plus and this kind of stuff. So it's just right now coming more into fashion in the equity space. So that's kind of a new,
Obviously, traditionally, everybody would say that ETFs are mostly passive. So this is kind of fresh, maybe not freshly, but relatively new development, I would say. Maybe I'd like to know also Adrian's perspective as you represent a fund manager also, and it seems like those strategies that have been run by you or other asset managers, traditional asset managers for years, are now adopted by ETFs who would replicate this kind of strategies, like you mentioned also, Tomas, and of course charge a little less or 1 percentage point less. So the client's choice would be obvious. Switch from the investment funds to ETFs. But are there any obstacles that you see that are stopping this process?
Yes, so maybe first I would maybe politely disagree with the statement that obviously we are known mostly for thematic strategies. We also have those machine learning driven enhanced indexing. But I think replicating, for example, thematic strategies or traditional actively managed strategies with an ETF, there are studies that show that passive ETFs underperform in the thematic space, and it's very easy to explain why, because when you have an actively managed strategy, you need to select the manager, hire the team, you put in the research, you need to commit, there's a PR commitment to this as well, internally and externally. And no one stops anyone from launching 300 ETFs tomorrow, and then if only 50 survive, so be it. I mean, it's purely like admin account opening cost. So I wouldn't necessarily see them as competition per se, and I think investors who see the difference, they really value the delta in performance, in process, and in the, let's say, longevity of those strategies. Now, moving to the second part of your question, what potential obstacles there would be, I think that we really need to differentiate between the strategies that we see the demand for and then the wrappers. The wrapper, whether it's like a UCITS or whether it's an ETF, I think there are many markets in Europe that still remain inefficient because the selection process is not, it's facilitated through some sort of retrocessions. We had a couple of panels on the situation in our Polish market here, that maybe the competition is not perfect, and it's similar in other markets. So obviously this is, let's say, market inefficiency. But I still think that collectively we need to think about making decisions that make sense for everybody and not just individually for ourselves. What I mean by this, and it's an example from the Polish market that was mentioned by others here today. But if you read the quarterly earnings calls of major European banks, you can see what's going on. They say, okay, interest rates are going down. My revenue from cash accounts or cash and cash accounts is going down. I need to generate more fee revenue. I need to capture more of revenue going from investment products. I sell more of my closed architecture. So short-term gain makes perfect sense. Long-term, there are articles that say we can see plenty of mergers between European asset managers. We do not understand why US asset managers take over. I think we just choose not to see the link. Obviously, if we, as a sector and as a whole continent, if we provide products that are just not the best offering, then someone will find a better offering somewhere else.
Okay. At least during the previous meeting, actually, we saw an example of a private banking portfolio managed by one of the banks, built of ETFs. So at least this is something good, right? And good for customers.
So yes and no, because I mean, to me, using passive ETFs, it's a choice. Everyone has a. You are sure to underperform the benchmark with a passive fund. It's right, benchmark minus costs.
I think Kamil didn't say it's only passive ETFs.
No, but all I'm saying is going back to the point, the lower the economic growth, the more we need to look for others versus of alpha, and probably the benchmark minus cost will not be enough.
Okay, I have.
Sorry, I need to add one thing.
Just
on this one.
half a minute, Tomas.
Sorry for that, but just the ETF itself. Just to define that it's index minus cost is not really correct, because because the definition of the ETF and the setup of just more efficient withholding tax setup. Just if you look at S&P 500 or MSCI USA or MSCI World, you're actually outperforming the index because you are in a better withholding tax situation than the index itself is. So the performance of those really modern, very efficient, very competitive ETFs is crazily good.
Yeah, I think it's the passive versus active ETF. I hear you. I think we understand.
We've got some other kind of revenues, like from the security loans, etc. Anyway, I've got one more question to Radek. As during this discussion, we're seeing that kind of product range or product offers of active asset managers, or the traditional asset managers, rather, I would say, are converging with the product offers of ETF providers. And the question would be how you, as traditional other asset managers, can differentiate and provide something else for customers, which is not maybe necessarily bigger alpha, because it's also it means higher risk, but maybe something else that ETFs cannot deliver to clients.
Thank you for this question. I think we are, as an industry, very product and performance driven, especially on such forums like this or any similar. And I was pretty surprised that we are rarely referencing the clients over the last two days. So of course, we can discuss active, passive, what type of wrapper, traditional alts, thematic, whatever kinds of flavors, but I would say that really putting client into the focus is one of the best strategies, and we try to deliver on that. So being more client-centric, looking from the lens of customer experience, not only products or performance or service, but looking for this different type of differentiators. Can be even the simplicity, because we are becoming more and more like commodity providers. The funds are becoming more and more similar, especially on the Polish market, and I think this extra feel and care for the client, in any way we define content, better digital experience platform, looking at the customer journeys of the clients, transparency is the way to differentiate and win a bigger market share.
So something that cannot be directly valued.
But Radek, also, just to add on this one, the decision on the asset allocation is one of the most important kind of factors for the client. What do you really get? So in the end, the selection is quite nice, and to have maybe 2% outperformance, it's okay. But in the end, just what you have overall is the most important topic to have.
Yes, of course, but the question was assuming that we can deliver the same rate of return to the customer. Guys, we have 2 more minutes, just in time for one final question to everyone. And I really expect a short answer. What is the most original or interesting use of AI in your company? Starting with Bogumił.
That's a quite interesting one, right? And everyone looks into AI now. It's some banks using some quite tangible use cases. We look on the AI, how can we optimize the costs, increase efficiency across the board, and increase client experience. And
Something more specific.
One example is settlements predictions. We're doing a pilot on the AI using the historical and real-time data to show which transactions will fail and what would be the settlement cost there to optimize the spend on the asset managers.
That's very interesting. Tomas, very short.
We actually use AI for index methodology. So how do we invest? Because future topics like AI or future mobility, how do we make it investable in an ETF? We just work with patents data. And on the background with patent data, how do you analyze these millions of patents on the background? We use AI crawlers. So really to find out, to have a dynamic approach to find the future winners of, for example, future mobility or AI big data. So here it's actually AI on the background helping us to manage this huge amount of data.
Thank you. Adrian?
So the question is, what really moves the needle? And in the spirit of friendly debate, I think we can save costs however we want. We use mostly artificial intelligence for managing investment strategies. So without actually human input, we can deliver 100, 150 bips outperformance. I don't think that any level of operational efficiency will match that. I'm happy to be challenged.
Thank you. Radek?
So there are multiple uses, obviously, throughout the value chain, but say the most interesting would be in the quant strategies. We analyze voice recordings of quarterly meetings of boards, and we cross-check it with out-of-samples voice recording of the CEOs, and the AI is giving the signal whether he was or she was telling the truth, whether was hesitant in the answers, and provides range of different signals on the sentiment of this voice recording.
Very interesting. Okay, guys, thank you very much. Let me thank you for participation in the panel, and yeah, thank you very much.
Thank you.